Hi there, in this video we'll explain Form IHT430 and when charitable giving may qualify estates for reduced inheritance tax rates.
Imagine you're an executor, managing an estate worth well over the £325,000 no-rate band, and a tiny misunderstanding about charity rules ends up costing the family tens of thousands of pounds in unnecessary tax. Ouch. Welcome everyone, I'm a tax advisor from My Tax Accountant, or MTA for short. We're a UK accounting firm, and we spend our days helping individuals and businesses untangle HMRC compliance. In today's explainer, we're diving into the reduced rate of inheritance tax and Form IHT430 here in the UK. If you've recently been appointed as an executor, this is exactly what you need to know to protect the wealth you're looking after.
Let's look at the financial stakes right out of the gate. The standard inheritance tax rate in the UK is a pretty hefty 40% on anything above your tax-free allowances. But under some very specific rules, HMRC actually allows this rate to drop to a reduced rate of 36%. So how do you get there? Well, by leaving at least 10% of the estate to a qualifying charity. Now, I know it sounds really simple on paper, but the mechanics of actually proving this to HMRC and claiming the relief, that is exactly where so many executors get completely tripped up. The compliance burden is huge, and it's so easy to overlook the strict details. Missing them could literally cost the estate massive amounts of money that could have gone to the family, or, frankly, a great cause.
Okay, let's dive right into this. Here is our roadmap for today. We'll start with the 36% tax rate solution, then look at splitting the estate into components, followed by the three-step baseline calculation. After that, we'll cover merging components for tax savings, submitting Form IHT430 properly, and finally, wrap up with next steps and professional advice.
Section 1. The 36% tax rate solution.
So, the core idea here is that the government actively wants to encourage charitable giving. Give a chunk of your wealth to a good cause, and they'll take a smaller slice of what's left. Makes sense, right? But HMRC has incredibly strict definitions here. The money absolutely must go to a qualifying charity. That specifically means a UK-registered charity or a community amateur sports club managed by fit and proper persons. And here's a did you know moment for you. Following recent law changes, EU and overseas charities generally no longer qualify for this relief at all. This is something many taxpayers first discover when reviewing their tax position after a death, and trust me, it catches a lot of executors completely off guard. If the charity doesn't qualify under these current rules, the 10% test fails instantly, and you're stuck paying that full 40% rate.
Moving on to Section 2, splitting the estate into components.
Now, to really understand the math, we first need to look at how HMRC actually views an estate. They don't just see it as one giant pot of money. No, for the purposes of this specific 10% test, the law divides the estate up into three distinct categories, which they call components. First, you have the general component. This covers assets owned entirely in the deceased's name, or property held as tenants in common. Second is the survivorship component, which covers joint assets that pass automatically to a surviving owner. Think of a joint bank account, for example. And finally, the settled property component, which includes assets held in certain trusts. Now, what's really interesting here is this critical detail. The 36% reduced rate applies strictly component by component. So your general assets might completely qualify for the 36% rate because of a generous charitable donation in the will, while the survivorship assets might fail the test entirely and get hit with the full 40% rate.
Right, Section 3, the three-step baseline calculation.
I know, whenever we start talking about statutory tax calculations, it can look incredibly intimidating. But don't worry, we're going to break down the exact 3 steps straight from the HMRC manual that you have to use to see if a specific component passes the 10% test. The goal here is to find what's called its baseline amount. Okay, step 1, you take the net value of that specific component. So that's assets minus liabilities and any other exemptions, but you entirely exclude the charity gift for now. Step 2, you deduct that component's apportioned share of the available nil rate band, which is typically $325,000 across the whole estate. And step 3, you add the charitable gift back onto that step 2 figure. The final number you're left with, that is your baseline amount. To unlock that sweet 36% tax rate, the actual amount donated to the charity has to equal or exceed exactly 10% of this specific step 3 figure.
So what does this all mean when things don't go perfectly? What happens if your charitable gift falls just short of that 10% threshold? Let's say your baseline amount is £500,000. That means you need to give £50,000 to charity to get the tax break, but the will only left £48,000. Do you just throw your hands up, accept defeat, and pay the 40% tax rate?
Absolutely not. You actually have strategic options at your disposal to fix this retrospectively. Things like post-death variations and the strategic merging of estate components.
Which brings us nicely to Section 4, merging components for tax savings. As you'll see, the law actually allows executors to proactively alter how the math is applied to rescue those tax savings. Let's look at a highly practical example. Let's call her Elizabeth. Her estate included a joint bank account worth £30,000. That is her survivorship component. She also had £750,000 in solely owned assets, the general component. Now, her will left £75,000 from the general component to cancer research, but nothing was left from the joint account. If we calculate these separately, the general component passes the test easily, boom, 36% rate. But the survivorship component fails, meaning that $30,000 joint account gets taxed at 40%. However, if the executor formally elects to merge these two components, they're now treated as one big $780,000 pot. And this brilliantly illustrates the strategy. Because that $75,000 charity gift from the general component is so generous, it more than covers the 10% threshold for the new combined baseline amount of £455,000. By simply electing to merge them, the 36% rate is unlocked for all the assets across the board. You've just saved thousands of pounds instantly.
And here is a professional tip for those of you currently planning your own estates or maybe advising loved ones. Please don't just leave a fixed flat sum like £50,000 to charity. Asset values fluctuate wildly before death, especially property, right? If your house value shoots up, that £50,000 might suddenly fall below the 10% baseline mark, and that's going to cost your heirs dearly in tax. Instead, use a formula-based clause in your will. Your solicitor can draft dynamic wording that automatically leaves exactly 10% of the baseline amount to your chosen charity. This basically guarantees you secure the 36% rate no matter how your asset values change over the years.
All right, Section 5, submitting Form IHT430 properly. Now that we understand the strategy, how do you actually prove all this to HMRC? Well, you need to submit Schedule IHT430. This specific schedule is absolutely mandatory if you want to claim the 36% rate, elect to merge components like we just talked about, or even if you want to intentionally opt out of the reduced rate. It gets submitted right alongside your main IHT400 inheritance tax return. Now, a really critical compliance detail here is that if you are electing to merge components, this schedule must be physically signed by all the appropriate persons who are liable for the tax in each affected component. So practically speaking, that might mean you as the executor have to spend time tracking down surviving joint owners or remote trustees just to get their wet signatures before filing. It's a real administrative hurdle and you simply cannot ignore it.
Let's move on and see how this builds. If your estate requires some really complex grossing up, or if the interaction rules between trusts and joint assets are just getting way too complicated to calculate manually, there's a lifeline. You don't actually have to complete the final tax calculations yourself. You can simply fill in the basic gross values, your liabilities, and the charity exemption figures right on the schedule and just submit it. HMRC Trusts and Estates will actually do the heavy lifting for you. They'll calculate the baseline amounts and figure out the final correct tax liability.
But, and this is a big but, you must keep a very close eye on the calendar. After the date of death, you generally have 12 months to submit your main IHT400 form just to avoid late filing penalties. And remember, the tax itself actually starts accruing daily interest after just 6 months, so speed is definitely of the essence. However, the absolute final statutory deadline to submit Schedule IHT430 or to use a legal deed of variation to bump up a charity gift so you hit that 10% mark is exactly 2 years from the date of death. Miss that 2-year deadline and you completely lose the right to claim the 36% rate or merge components, barring some highly exceptional HMRC discretion. The clock is quite literally always ticking.
Finally, Section 6, next steps and professional advice.
Look, getting these details wrong can lead to missed savings, incredibly stressful HMRC inquiries, or even severe compliance penalties. If you're an executor right now, here are your actionable steps. First, review the will immediately for any charitable legacies. Second, categorize the estate into its general, survivorship, or settled components and run those step 1, 2, and 3 calculations to find your baseline amounts. Third, if a component is falling just short of that 10% test, urgently look at your options to merge components or legally vary the will. And finally, please do not attempt to navigate this incredibly complex landscape completely alone.
At MTA, our expert tax advisors literally live and breathe these regulations. We can review the estate, calculate the exact baseline amounts for you, handle those strategic merging elections, and ensure Form IHT430 is submitted flawlessly. Let us handle the heavy lifting so you don't have to spend your nights worrying about HMRC rejecting your claim.
You can reach out to us directly at info@mytaxaccountant.co.uk to arrange a consultation.
Before we wrap things up today, I just need to note that the information provided in this explainer is intended as general guidance only. Tax law is highly specific to individual circumstances, and you should absolutely obtain personalized professional advice before making any financial or tax planning decisions.
I'll leave you with this final thought. Inheritance tax doesn't have to be a rigid 40% penalty on your life's work. With proper planning, is your estate currently structured to maximize the legacy you leave to your loved ones and your favorite causes, while legally minimizing your tax burden? If you aren't absolutely sure, well, it's probably time to find out. Thank you so much for joining me for this explainer, and we look forward to hearing from you at My Tax Accountant.